Well, as stocks tumbled, so did yields on the benchmark 10-year Treasury note. They are now below 2.5%. That is a 7-month low. So what's driving bond yields lower, and will they drop even further? Steve Leisman gives 3 reasons why they could.
A funny thing happened on the way to the year that interest rates were supposed to march higher. They went lower, much lower. And some are now doing an about-face and forecasting they could keep going down from here. The yield on the 10-year sank below 2.5% for much of the day, a place it hadn't been since October 2013. And there are now 3 reasons some people think that rates could fall further from here. First, it's the economy. It was another day of mixed economic data with a strong improvement in jobless claims offset by a weaker manufacturing report. The housing data, meanwhile, continues to be weak. The upshot, the economy might have contracted in the first quarter while it looks set for a decent rebound in the second quarter. But take them together, first half growth currently forecast to be an anemic 1.6%. Mostly, it was a bet on stronger growth this year and higher inflation that underpinned the call for higher rates. Neither seems to be happening. Second, central banks are still easy and getting easier. The European Central Bank is expected to ease in June. The U.S. Fed is reducing its bond purchases, but still buying, taking long-term paper off of the market and helping drive down rates. Finally, long-term yields have been coming down for almost 30 years. Some economists believe they have further yet to fall because the post-financial crisis economy is going to grow sluggishly for years to come. Since companies have billions of cash on their books, they don't need to borrow as much as they did. Consumers, meanwhile, burned by too much debt during the recession, are less willing to take on more of it. Less demand for debt means lower interest rates. On the upside, lower rates mean consumer borrowing costs should come down for homes, autos, and credit cards. And the lower the yield on bonds, the more attractive stocks could become. Relatively, that is. For Nightly Business Report, I'm Steve Leisman.